Hello, everybody. It is Monday, September 28th, end of the quarter. Got some window dressing in the stock market today, and I would expect a little bit more tomorrow, although I'm not so sure what will happen on Wednesday after the debate. No idea. No idea what's going to happen in that debate tomorrow night. I'm so excited about that debate, I'm going to go watch baseball instead. So, today I got out the plug-and-play ETF portfolio models for Q4. You will notice a dramatic simplification. So when you get a chance, go ahead and read this. I updated the cash so that you could see kind of what a long-term cash position should be for most people versus what I'm recommending now, which is huge. I do think Q4 is going to be brutal. I think it'll be a lot like 2018. If it's not, I'll be shocked. But the Fed has shocked me before, so we'll see. There is a lot of liquidity out there. However, I was screening stocks for last week, and my gosh, just using Stock Rover to rank things, I can show you right here that it doesn't even matter what you're using. We'll just use S&P 500 and take a look at returns. Or actually, might want to use momentum. Well, here, this is it. Just take a look at the 52-week range. Oh, this isn't what we want here. Where's the S&P 500? S&P 500. There we go. What you find in the S&P 500, and this is across everything, is just look at how many stocks are at or near their 52-week highs. It's just unbelievable. Scroll and scroll and scroll and scroll and scroll. I mean, there are a lot of stocks that have either broken out or they hit their high and they just recently came back a little bit. There's a lot more downside to this market. So with that in mind, the plug and play, I simplified a little bit. I removed the currency holdings because those really require you to be a swing trader and use options. So that's not part of a core portfolio. It doesn't mean that you shouldn't have currency positions. If you're allocating 10 or 20% of your money to swing trading, it's something that you can do there. So you just have to think of your portfolio in sleeves, your core ETFs, your buy and hold stocks, your swing trading stocks, and then any other swing trading that you're doing. So think of your portfolio in sleeves or mini baskets within the bigger basket, and I think that will help you. So you'll notice that I reduced QQQ relative to ARK Innovation. And my logic here is two-part. One, as good of an index as QQQ is for large cap. The reality is that the mid-cap stocks are beating the large cap stocks, and they have higher growth rates. And maybe not quite the ironclad balance sheets that you find in QQQ, but they're making money and they're starting to build those huge balance sheets. So I'm leaning more towards ARK Innovation versus QQQ. But one thing to keep in mind is in the stock portfolios, I have decided to buy Amazon, Google, Microsoft, and Apple. So Apple, Amazon, Alphabet, and Microsoft. So AAAM. So I don't know, we're going to have to come up with an acronym for that. We'll put Microsoft at the start. We can call it MA. So Microsoft, Apple, Alphabet, and Amazon. We'll call that the MA stocks. And so for that reason, I'm not owning as much QQQ because I am going to buy the MA stocks if they come back to me. I got rid of the Invesco Solar, not because I don't like solar. It's definitely something that you can trade. But the Wilder Hill Clean Energy for the last 1, 2, and 5 years has done just as well, and it's more diversified with lower beta. So given similar returns, why not take the one that has less volatility? So I pulled out the chart here, and this goes back 4 years to the start of the Trump administration, and you'll see that The candlesticks are PBW. The red is tan, so they're about the same. And then QQQ with the recent correction is down here. If you look at 1 year, again, PBW is about the same as tan, and then QQQ is down here. So I do love the alternative energy, and what you can see if you do a head-to-head between PBW and TAN, and they're both Invesco funds, is 42 holdings in PBW versus 28 in TAN, and again, diversified to include solar, but not be exclusively solar. So I just like this better from a little bit of a safety standpoint. Again, doesn't mean you can't have TAN. You can split these two positions up if you want to. You can keep a little bit of this in your trading sleeve, just whatever fits you. When you take a look at the top holdings, you'll see some overlap, right? Sunrun is in both of them. Vivint Energy is in both. Vivint Energy and Sunrun, of course, are merging. And then you have some of the other companies in here. SunPower, I would imagine SunPower is over here somewhere, probably page 2. SunPower, there you go. You know, you got Maxion down here. I would imagine Maxion is, again, down there. Itron, look at that. Itron is in there. So you have a wider range of types of companies with the Power Shares Global Clean Energy, Wilder Hill Clean Energy. And I just like that from a little bit better diversification, a little bit lower beta, and it hasn't given up anything in performance. There are going to be times when solar gets really hot. So after a big correction, we'll probably at least trade the solar, right? So definitely I could see some spikes in solar, but you do want to be across the entire clean energy sector. Semiconductors, they make the smart everything world go. Try as I might to try to short this thing, I can't quite get ahead. So at some point we're going to want to own semiconductors. What's nice about semiconductors is that there are regular corrections, at least historically there have been. There hasn't been one lately, I guess March. I think that we should get a chance to buy semiconductors soon. Now, I have Berkshire Hathaway in here in the ETF, and I think it's important that you own some. If you paid attention to what Berkshire Hathaway has done lately, they added Barrick Gold, they added Japanese brokerages, they added natural gas, and they got in on the Snowflake IPO, and they got the IPO price versus the price at the end of the day, which I think doubled. So Berkshire Hathaway, I think, is something that you're going to want. They're sitting on a mountain of cash, and I don't know you want it to be a huge part of your portfolio, but as a better proxy to the economy versus the S&P 500, I think that Berkshire gives you exposure to some of those dividend stocks and resource plays that are hard for us to get in an ETF portfolio without getting a bunch of stuff that we don't want. So I'm kind of letting Buffett and his team, more his team now, Combs, and I forget the other guy's name, they're picking out some of our not quite as new economy stuff, right? Not QQQ or innovation types things, but well positioned. I mean, they got into Snowflake and Barrick Gold, and they're really just looking to make money. And if they catch this correction that I think is coming with $150 billion to scoop up their 10 or 12 favorite things, I mean, just imagine what Berkshire Hathaway looks like coming out of that. The other nice thing about Berkshire Hathaway is they buy back their own shares now. So there isn't a huge floor underneath Berkshire Hathaway. So I have the charts linked now, and I do think that this is the range that you're going to want to buy Berkshire, somewhere low 200s down to the 190s. You know, we might get a price in the 180s, but we do know that they start to buy their shares back in here. See, that's what happened here. So once it gets down to this bottom orange line, you ought to be buying. because Berkshire is going to start buying their own shares at that point. Van Eck Gold Miners and the Spider Gold Trust, we talked about that on Friday, that we want to even those up and to basically take the part of the portfolio that would normally be fixed income in an 80-20 portfolio and fill that with alternatives. The other 4% is going to be your cash, or if you want to do some currencies or whatever else. Now, we had an alert on Indonesia ETF about a week ago, and I've actually started to write a piece about that. When we get an alert, we don't want to just immediately jump in. What we want to do is take a look at the chart and say, okay, what is that alert telling me? And in this case, the alert is telling me that we're getting close to wanting to buy Indonesia. Now, does it come down a little lower? I think probably. And again, I think probably close to this orange line, about 15-ish, is probably what we're going to see. Could it go down lower on a dollar that gets much stronger? It could. The one thing to remember about the dollar is, and I go through this all the time, and I know I have to repeat myself because everybody's getting bombarded with these dollars going to collapse, dollars going to collapse. You know, Jim Rickards has been wrong for so long. I don't know how he stays popular. He's just been wrong and wrong and wrong and wrong. But whatever, people buy his books. The dollar trades within a range. We showed that chart the other day. When it gets too low, that causes a financial crisis. When it gets too high, it beats up markets. So there's a range that's going to trade in. The debate tomorrow night could put a little bit of a floor under the dollar. If Biden doesn't look silly, I think that probably there's a floor that's going to start developing under the dollar. I talked about that about 2 weeks ago, is when the market starts to believe that Biden's going to win, that's when the floor under the dollar, because he's going to do more fiscal than monetary, and the fiscal policies generate growth and economic activity and a higher velocity of money, which drives inflationary impulse. So while I don't think we get a huge inflationary impulse, I do think that you could see 3 or 4% inflation by next year, just on the increase in economic activity as the pandemic winds down, which I think is going to happen next year sometime, and you get fiscal policy from the Democrats if they win the way that I think they're going to win. You know, my prediction is that Biden wins and the Democrats get the Senate. So we'll see. Now, if I'm wrong and we keep President Trump and a Republican Senate, well, that means more trickle-down economics and more heavy monetary policy. So that would drive the dollar down quite a bit, and we would have to reassess what we want to buy. Now, if we pound the dollar down, that's actually good for emerging markets, so this probably takes off. But if the economy does well, this is a resource economy, it probably does well. So really what we're really just looking for is an entry on Indonesia as they've finally started to get over some of their bigger problems. And we have to remember what Indonesia is. They're a very resource-rich economy that does a lot of business with China. So China needs Indonesian resources just like they need Australian resources. And that's why I'm recommending both Indonesia and Australia, because both are going to benefit from a rebound in the economy as resource producers. Germany is the backbone of the economy in Europe, so I don't want broad European exposure. I'm happy with German. However, there's probably a pan-European fund out there that you could switch for this if you didn't want to be just German. But I think that these are the three that we want. And when you take a look at some of the international companies in here, and in here, and in the gold miners, and in Berkshire Hathaway, you're getting other international exposure that can give you the lower beta and diversification that you want for a core portfolio. Now, if you're a retiree, some changes, and the one thing that I will talk to you about is that if you really want to be more in a 60-40 type of portfolio, and in fact, I have to change this because I'm not using bonds anymore, not after the run-up. I would just tell you to hold more cash in your bank. Honest to goodness, use a money market account or use some sort of municipal bond account. I think municipal bonds do pretty well if Biden wins, because he will help the states. If Trump wins, he's not going to help the states as much, and the municipal bonds probably don't do well, and you'll be happy to have extra money in a money market if we get turbulence. So I would tell anybody, in your retirement accounts, in your IRAs and things like that, skip having bonds. Just skip it. You don't want any bonds. And to create that margin of safety, use municipal bonds in a non-qualified account and then money markets at the bank to get yourself to the safe level that you want to be in. There's just no reason to own bonds in really any type of IRA, and really any type of brokerage account unless you're segregating it as kind of its own sleeve to be low risk, in which case muni bonds are the way to go. And you know what, I'll add a note here for that. And then higher cash balances at the bank to make sure that you have that 6 months to 2 years of expenses in the bank. I think for me, having 6 months in the bank is plenty, because I'm earning. If you're retired, you probably want about 2 years of fixed expenses in the bank, or a year plus anything that you think that could come up, a new roof, a new furnace, things like that, new car. Rather than QQQ, I've got the First Trust NASDAQ Tech Dividend Fund. It doesn't do as well as QQQ, but when you blend it with ARC Innovation and then this Wisdom Tree International Dividend Growth, which has really been a good fund, you can see the big trend, sell off 2018, big run up, coronavirus. There's a lot of value internationally right now, and I'm adding a couple to the stock list, in fact. So if this comes back on volatility, I think probably the top right up in here, and I'll put some orange lines in here for you. But I think lower 30s here, 32, 33 is probably where you want to get in on this. To give you an idea of what is in this fund, go to the holdings here, and you see these, you're gonna get pretty good diversification here, right? Because you don't own these stocks. And if we really wanted to get granular, we could pull up the ETF database and take a look at even more of the holdings, right? So you take a look at these holdings: Unilever, Novo Nordisk. They're actually holding some cash. I'm not a big fan of tobacco, but it does well overseas. Tokyo. I mean, it's a pretty diversified fund, and it does well. So that chart that I showed you, it is a pretty good. I mean, it's done well. I mean, this is not something to be afraid of. It's volatile, so you do have to manage it a little bit. But this, when it fell off, was clearly a buying opportunity. When it fell off, was clearly a buying opportunity. If it falls off again, it's clearly a buying opportunity. And again, I don't know if it gets down to this end or this end. To me, that might be an election issue. But the balance between these funds, if you take a look, this is U.S. for the most part, but there's Alibaba and things like that in there, so there's some international. This is mostly international. Wilder Hill is like 30% international. Global Yield Co., right? These are the Yield Co. companies and other renewable energy that pays a dividend, which is the biggest trend out there, right? So, I mean, this is going to do well. You're going to want to get it on a pullback. It's a little expensive right now, but it's close. Doesn't take much for it to bounce, to fall back down here in the next month or 2 or 3, and then back off to the races. So this area right here, just take a look at this and this. So right in here is probably a pretty good buy. Could it get worse? I guess. I mean, if we have the Armageddon scenario, yeah, it could come down here. But the bottom of these boxes are pretty much the Armageddon scenario. Again, if I'm right about the election, it's not going to happen. Or if it happens, it'll be knee-jerk, happen so fast, and then it'll be another V-shape. So you're not going to want to miss on that. Again, Berkshire Hathaway, same reason as before. The gold, 18%. Excuse me, 8 and 8, 16%. Then the same international components. When I pick out, and I know that a lot of people will just skip these. You don't have to use these, but if you don't, then make sure you add to the global funds here, right? So don't skip these and then throw it in the U.S. If you skip these, throw it into this and this and this, because you want that international exposure. There's a lot of value overseas right now. About 20%-ish international, 20 to 30% international is pretty much what you want on a consistent basis. And I know a lot of people say 50, 60, that's baloney. 20 to 30% international gives you the necessary diversification that you need to give you some protection on the volatility. It comes with some management opportunities. That's why I like to use these, because we can trim and and buy and sell these a little bit just on those cyclical 6-month and 2-year trades. Some of those longer swing trades, and then some of the shorter position trades. These have enough volatility that we can make some pretty good trades. Buy it down here, sell it up here, buy it down here, sell it up here, buy it down here. And again, I think, Indonesia, I think, is pretty close right now. I would let it get down to this line, because I don't see it breaking through here unless there's some sort of an event. But right around here, this has got pretty big upside from 15. I mean, take a look at, it's been all the way up to 30, so that's a double. But if you go way back, this could really scream and be a triple or a quadruple. And I'm looking for, one of the things I'm looking for everywhere are backdoor ways to get in on alternative energy, right? So are there ways to participate in alternative energy and the smart everything world that requires a lot of copper? Are there ways to participate in the smart everything world and alternative energy without buying some of the stocks that are really bid up? So these resource plays, right, and then industry, Germany's industry, I mean, these are ways to get in on that sort of indirectly, right, kind of backdoor ways of participating. So, don't discount these and try to be too smart and say, well, I don't need that. I think probably you should, because you're going to get some Rio Tinto in there, you're going to get some mining stocks in there, and you're going to be able to get in on the fact that there's probably going to be a copper shortage in a year or two, and that's actually one of the stocks I added to the stock list. Is I added a copper stock. So I have thought all this through. This is not willy-nilly, let's just use some cookie cutter format. I mean, everything that I have in here with a reason. This gives you some broad international dividend exposure, right? This is the dividend side of technology versus all of QQQ. But then you get your innovation, and these two go together pretty nicely, right? Now, you could use QQQ if you don't have to tie yourself as much to dividends, and you'll probably do better with QQQ, but this will be a little smoother ride. And then if you're going to buy Microsoft and Apple and Amazon and Google anyway, there you go. Again, you can use TAN if you want to for part or all of that position, depending on your level of aggressiveness. But I'm going to err on the side of a little bit more caution. And then the Global X, Yield Co, and Renewable Energy, if you take a look at the holdings here, this is going to be something, you got Brookfield in there, you got some international companies that you would have never bought. This is a good fund to have. Spits out a good dividend, right? 3.43%, and it's got growth. So on a pullback, this probably goes up to around 4%, and then you get to make the capital gains. All right, let's take a couple of questions here. I'm not too worried about the Tesla positions. When you take a look at the amount of Tesla that is owned, remember, this is an actively managed fund. Tesla starts to tank, she can dump it. And she would. She's done it before, right? So you get a little Tesla in here. You get a little Tesla in here. That's why I don't include Tesla in any of my stock portfolios, because I know I'm getting schnibbles of it in some of these other things, so I'm not too worried about it. If this is a quarter of your portfolio, right? And Tesla's 10%, that's 2.5%, and then maybe you pick up another 0.5% in here, in the clean energy. So if your exposure to Tesla is 3%, given what it's done, I think you just have to have faith in the funds to dump it if they go to hell. The one thing I will say about Tesla is the fact that they're paying off their debt with shares. There's not a lot of argument against Tesla financially. It's just that the stock is overvalued. And what if he keeps doing what he says he's going to do? I mean, I don't think they're ever going to sell 20 million cars in a year. If they do, it'll just be, the tip, it'll be the pinnacle. I don't think it'll be a regular thing, but you could see in the late 2020s an awful lot of EVs getting sold, and there could be this big turnover in the whole car inventory of the planet. And what if oil does get expensive? I don't see oil getting expensive in the next several years, but what if supply gets so constrained ahead of demand falling off? Well, then if oil goes up to $80 or $100 a barrel again, then what happens? And people switch to EVs even quicker. So, I mean, there could be a few years where EV sales are so strong that everybody sets records, but then you settle back into the slow growth forever economy. Yeah, I don't know if that's true for ETFs. I know that's true for mutual funds. Somebody said that they can only have up to 10% of an individual stock within active funds. And like I said, I know that's the rule for mutual funds unless you get an exemption. I don't know if that's the rule for ETFs. Maybe it is, maybe it isn't. But I have noticed that, that's what Kathy mentioned specifically about Tesla. Yeah, because I have noticed that the times that they've gotten over 10%, they pulled it back pretty quick. So, you're not going to get a ton of Tesla exposure. But if, you have on aggregate a couple percent, give or take, in Tesla through funds, especially a managed fund, I just don't think that people who are afraid of Tesla should be afraid of that. It goes up. I mean, at some point you gotta stop arguing. I mean, I think it's overvalued, but at some point you just say, whatever, I'll buy Ford on the side. All right. So as I mentioned, Tuesday, tomorrow, we'll do the stocks because I have the plug and play just about done. And in the future, we're only going to do Monday and Friday webinars. I will clean up the schedule online. There was a little problem today. I think I logged into the wrong meeting. I logged into an old meeting. Make sure you get your questions in the Ask Me Anything threads or in the forum over at Fundamental Trends so that we can have a real clean Q&A at the end of Monday and Friday, and I'll click off the recording and then turn it back on so that we can have separate recordings. Also, Stock Rover will be a guest in the next month or so on a Friday. We'll talk about screening for ETFs in one session and then screening for stocks in another session. All right, everybody have a good night, and watch some baseball because it's almost over. And keep your mask up. But, if you're like me and you've been exposed already, hey, go out and do something. I'm just kidding. But that is kind of how it makes you feel. You feel like, oh, boy, Tour de France. Yeah. I never even got my bike out this year. I'm so upset with myself. I walk the dogs a lot, though. So, all right, everybody have a great rest of the week. I'll see you tomorrow morning.